we're going to start off today with another follow-up from a coaching session I had this morning about that covered call approach, far out in time and in the money. One of the default searches that we have under covered calls called the simulated CD position. To access any search in Power Options to find the trades that meet your needs, just go to the specific strategy tab. We'll go to covered call, and we're going to go right into the search tool. And the search tool is where we can see potential trades based on default criteria sets that we have for you that you can use as a stepping stone to create your own personal search. Now, I have many saved searches here on our webinar account from different presentations that we've done. But if you're just starting out, the main ones, the main ones you'll see are the at the money covered call, 1 month out, at the money positions as a default, in the money covered calls, the monthly picks of the day, Ernie's approach to identify monthly covered calls that are slightly in the money that he backtested to show a targeted return that he was looking for consistently without a lot of management. Out of the money covered calls, just 1 month out looking for out of the money, the weekly picks of the day, and what we're looking at here is the simulated CDs. This default search is looking for in the money covered call opportunities that are relatively far out in time, sometimes almost 2 years or more out in time. We see some here from January 2023, where we're in the money, but what we're looking to accomplish is a strong downside protection, meaning that the premium we receive against the stock price gives us a high percentage rate of how far the stock can fall before we start losing money on the position, with a reasonable return if assigned at the end of the extended time frame if the stock is trading above the short-term strike price. Now, in general, we probably wouldn't be going this far out at 567 days. Let's put this down, change the criteria. So when you're starting off looking at a default search, simply scroll down below the listed trades, and you see the parameter field. Over here on the right, you can see the active filters, the exact criteria that is being used for the specific default search that you're viewing. And you can change these criteria any way you want to meet your personal trading needs. We're going to limit this down to just 180 to 250. We're not going to go to the 567 days out in time out to 2023, although those numbers look pretty impressive for that first return. Now we just click submit to rerun the search. And as we expected, we're just out to January 2022, 203 days away, February 231 days away. We still have 31 results, and Marathon Patent Group is still in there, but with a different strike, still offering a 39% downside protection for 203 days of a covered call trade, and still offering a potential 36% return over a little bit more than a 6-month period in this case, as long as the stock stays above 25. We'd be buying the stock at 30.29, selling the January 25 call for about $12, $11.90, $12 at midpoint. Now, why am I going through this? Well, the base criteria we're using, in addition to the extended time frame, is we want to be at least 15% in the money to give us that better downside protection, but still earning at least a 7% annualized return with that extra protection in place. And some basics for just a minimum option bid price and bid-ask spread. And then we have our stock criteria. For the technicals, we're just basically looking for a stock that's trading above the 50-day moving average, and we're using a broker recommendation of less than 2, meaning the stock is just a strong buy or a buy recommendation, 1 or a 2. In the fundamentals section, we're limiting the stock price between $9 to $100, looking for a relative PE ratio, and looking for mid to large cap stocks. Now, this is measured in millions, but anytime you have a question about what a specific filter is on Power Options, simply hover over the text link. You'll get a pop-up definition here. We see that as this is measured in millions, if I just wanted to look for mid-cap stocks or higher, I'd want to use a range of greater than 2,000 to simulate greater than 2 billion for the market cap in that case. Now, the question that came in or the coaching session this morning, I believe at 11 a.m., was I'd like to do long-term covered call positions with a certain portion of my account, but I want to do it on relatively strong but stable stocks, possibly the Dow 30. Well, this is a good starting point to use with the default criteria for the simulated CD to see what matches your criteria. We might want to up the stock price a little bit. Let's take that up to $250 for some of the larger stocks that are available in the Dow 30. And now we want to go to lists. This is where you can screen specifically against a specific sector or industry, or a given stock list as well in any strategy. So if I click the stock list dropdown, I can have my watch lists and I can create those and screen just against those. I can create my own search, ETFs or ETNs to remove, for example. But we want to look just against the Dow 30. So let's go ahead and add that in. We changed the stock price slightly. That was it so far. And let's go ahead and run the search. Now, no stock options meet our search criteria. Why do we have this? Well, here's the problem. Those initial positions that came up with the simulated CD search that matched being at least 15% in the money for 180 days out in time still offered that strong downside protection and the reasonable 7% return if assigned, likely aren't going to be the same stocks we're going to see in the Dow 30, which have a much lower volatility and implied volatility on the options. Although this isn't a bad approach, it's sort of a conservative, very conservative, safe approach. You might get the advantage of some dividends on the dividend-paying stocks in the Dow 30 list with this far out in time covered call approach. But we have to make other adjustments in the position. We're going to have to lower the annualized percent return, perhaps maybe down to 5% or more, to allow some others to come in. Also, with these lower volatility, more stable Dow 30 stocks, we shouldn't expect to be going 15% in the money and still seeing close to a 1% return per month or even a 0.5% return per month over the next 6 months. We're probably going to be closer to maybe 6% or maybe 7% in the money, hopefully to see those type of returns. And one other thing I came across, even though these stocks are more stable, tend not to move that much, usually highly recommended, but it might be a good idea to sort of move this average broker recommendation up a little bit to allow more of those to come in that specific Dow 30 list. Let's go ahead and run the search. Okay, and now we have a good list of results. We've got Apple, Salesforce, American Express, Nike, Cisco, Visa, Amgen, and Walmart. As we expected, we can still go out that 6-month period. It's about 200 days out in time. We're still going to have a good downside protection. If you feel fear, I should say weakness in the market, where these covered calls are still giving us an 11, 12, 14% downside protection, even almost 10% on Walmart, 203 days out in time. But the annualized returns, as I mentioned, are much lower. We're not seeing those 15% returns, annualized returns. We're not seeing those high returns. We're just looking at about an average annual return of 5, 6, 8% or so on these positions because of the low volatility. Now, we could go less in the money to get the higher return. We could go closer to at the money to get the higher return and keep a reasonable downside protection. But again, it's give and take based on your needs and what you would look for. So the first case on Apple, it's right about 140. We could buy the stock at 140, sell the January 130 call, and collect 1638 or so at midpoint, hopefully. And again, that gives us an 11.7% downside protection. Only a 5% static return, midpoint if assigned, but an annualized return of 9.3%, assuming we could do this every 200 days over the course of a year. Now, is this a good play? That depends, again, on your trading plan and your goals for the position. What do we naturally know Let's go to the option chain. What do we naturally know about covered calls, credit spreads, cash secured naked puts? Well, they follow the same basic rules we'd expect for any option strategies. Whenever you're selling premium, it is always preferred to sell month by month by month in order to get the highest annualized return. In other words, if we just go out to July, standard expiration 14 days away, that at the money 140 call is trading at about 190. Okay, so let's go 5 times the amount out in time. So let's go 70 days out to September. The 140 call is at $6. Is that 5 times the premium we could have received for the 14-day trade in July of $1.90? No, it's only about 3 times as much. The option that's 5 or 6 months out in time won't be 5 or 6 times the cost. We get a better annualized return. Again, if the stock stays the same price, volatility stays the same, we just keep selling the at-the-money option, we'll get a much higher annualized return selling week by week than we will going month by month. We'll get a much higher annualized return selling month by month than selling every 6 months out in time. And we'll also get a higher annualized return selling 6 months out than selling 1 year out at the beginning. Although I'm taking a higher premium up front and I'll see an initial higher downside protection, we will have a lower annualized percent return because the option that's 6 times the amount out in time is not 6 times the cost. This works in reverse. If you're looking to buy call options or buy put options, of course, to protect your stocks, it's best to look 4, 5, 6 months, maybe 8 months out in time, so you have a lower annualized cost, assuming you're planning on staying in the position for a longer term, looking for longer growth. So why is the simulated CD search here? Is this a good approach to use? Well, the basics behind why an investor would use this is that if the returns that you find on the positions with the comfort of the downside protection you get for the farther out in time return does match your trading goals. In that case, let's shorten this up a little bit. You're just looking to be conservative, make 0.5, maybe 1% per month over the next 6 months. You get close to it here, 5.2%, with the potential for little to no adjustments. Meaning that until this stock falls 11 or 12%, you don't have to worry about rolling or adjusting the position. It can fall almost 12% before you're nearing the break-even point at expiration. You have time on your side to withstand it where you're not looking to roll the position every week or every 2 weeks if you want to stay in the stock, or even month by month if the stock starts to move against you. This isn't an approach for everyone, but it's a way to be a little bit more hands-off, have that security of a little bit more downside protection on a position, still be able to take in a reasonable income, although the Dow 30 stocks we know are going to give us a lower income, lower profit due to the lower implied volatility. That doesn't exactly mean that looking for stocks with a higher implied volatility that will offer a higher premium and a higher return is necessarily a good idea either. Now, we saw some good numbers with just the basic simulated CD search, positions that were 200 days out in time on Marathon and others that were double the downside protection, double the percent return that we see on these Dow 30 stocks. But in the case of higher implied volatility, it's not always the best approach. You want to make sure you do your due diligence and research and analysis. I'm going to bring up Altimmune very quickly as an example. And we're going to go back to June 21st on the historical options chain. We're going to take a look at the July 16th series from June 21st. You can see there the stock's trading at 9.34 today, down 70 cents or so. This stock was at 15.64 on June 21st, and a covered call could be entered by selling the 13 strike call for almost $4.13. Let me just go to the call chain. I should have done that first, shouldn't I? Excellent. So on June 21st, at a midpoint of about 413, with the stock trading at 1564, we would have had a cost basis of around $11 on this position. And the potential return, if assigned, 25 days away, of 12.9%, with a 26% downside protection. But of course, that doesn't help in a situation where a biotech stock or something has an event coming up. And in this case, it was supposed to release its report findings of the alt-COVID drug that they were developing, an alt-COVID vaccine, I believe they were developing. And they released that on Thursday when the stock had run up to almost above 17, and then it quickly collapsed down to 10, tried a little recovery, went down just to about $9 or so as well. That higher implied volatility. In this case, on the day we were looking at it, the at the money is at 1.3. That 13 strike was at 1.7. This is so what you might call 175% implied volatility, 164, 215% implied volatility. The premiums look fantastic. The returns and downside protection look fantastic for a 20-25 day trade. If it looks too good to be true, it probably is. There's something going on with this security which may require deeper due diligence to find out what's going on between now and expiration that may cause the stock to swing wildly, specifically wildly against your direction. And that's when I'd want to use these further research and analysis, go into the company information, go to the news, the profile, see if I can, maybe in the news section, look at conversations of what other investors are planning on this stock going forward, what it might do, so I can hopefully help protect myself against some of these large declines if I'm trying to focus on the high implied volatility. And as a good start, you might want to reduce the implied volatility on your general search to be closer to the average implied volatility, or not to be exceeding the average implied volatility by too much. How can you find the average implied volatility? Go into the Learning Center tool under Power Options. There's some basic information, tip sheets, webinars, strategy help pages. We want to go to Market Activity. And here you can see some earnings coming up this week, ex-dividends that are coming out this week, a list of those, 52-week highs and lows, market statistics, and optionable stock statistics. I want to click on that. This page does is it gives me a variety of the stock and option criteria that we track here on Power Options that you can search and filter by in those 23 different strategies. And we give the mean, min, and max price for all optionable stocks, indexes, and ETFs. So if I come down to the 20-day or 50-day implied volatility, we see that right now the average 50-day implied volatility for all optionable stocks is 0.39. The average implied volatility across all options, all expirations, calls and puts, is 0.76, almost double what the 50-day stock volatility is across the market. So if I'm looking for positions, I don't want to go double the implied volatility. I probably want to look closer to maybe screening for positions that where the options have an implied volatility maybe less than 0.9 or 0.95 without going too far as well. All right, so I just wanted to mention that there, looking at, again, the review of the far out in time, in the money, covered call approach, using more stable stocks, what we have to give up for the expectations. That maybe too low of a volatility might not suit your goals and your needs for your trading plan, but there are certain things that we saw even this week where it's not necessarily the best idea to look for the highest implied volatility and the highest return, even if you're 1 week out, 2 weeks out, or 3 weeks out in time. There's a balance there that you want to do, not just for covered calls, but for other strategies. If you see something that looks too good to be true, return that is so much higher than what's coming up with or what's available with other stocks with a similar underlying stock price and a similar structure that looks too good to be true, it might just be too good to be true. You need to do some more due diligence there. Don't just go for the one that has the highest return. See why it has the highest return and know why.